Hi everyone, welcome to the session. Let's go through this particular question and try to answer the following three questions A, B and C. So what we need to do is we need to prepare your given set of financials for Park and Sam. This is in relation to consolidated financial statement. So you need to prepare the income statement. Okay, so what we need to do is we need to prepare line by line consolidation, and what we need to do is we need to add all these revenue, cost of sales, administration expenses, all these things will have to be added to prepare the consolidated financial statement. So when you add, what we need to do is we need to identify any intercompany transactions. So these intercompany transactions will have to be eliminated, and also if there are any any unrealized profits, so those unrealized profit also will have to be removed from the profit. And also you are given the following notes. Park acquired 70% interest in the equity shares of SAM on 1st January 2012. This was acquired on 1st January 2012. However, you are given the financials on 31st December 2015. So therefore, there is no pre and post profit elimination here. We don't need to identify pre and post profit. The entire profit given here is all post profit. During the post acquisition period, Sam sold goods to Park worth 150,000 US dollars, including markup on cost of 20%. 1/5 of these goods remain in the inventory of Park at the year end. So now here you are given 150,000 worth of goods have been sold by Sam to Park. So therefore, Sam is a subsidiary company where it recognizes the profit. So therefore, when you identify the unrealized profit, the unrealized profit has to be removed from the profit of SAM when we allocate, when we distribute in this ratio 70 to 30%. The unrealized profit of included in the profit of SAM will have to be eliminated before distributing the profit. Now, since the amount is given as 150,000 US dollars and the markup on cost is 20%, so therefore we can identify here how much is the unrealized profit. So unrealized profit is equal to 150,000 divided by this is markup on cost, means 20% is calculated on the cost. So for example, if you take the cost as 100 and the profit is 20, your selling price is 120. So this 150,000 is the selling price, so you can simply divide this and times 20. So that's going to be 25,000 is the total unrealized profit, but they say 1/5 of these goods have been goods are remain in the inventory of Park. So therefore, if you take 1/5, which is going to be 5,000, so 5,000 is the unrealized profit. And apart from that, there is another intercompany transaction is given on 1st October 2015, which is the financial year end is 31st December 2015. So Park made 1 million loan to Sam. Interest is charged at the 6% annual in arrears. So therefore, whatever the interest income recognized by P has to be eliminated, and whatever the interest cost recognized in the finance cost by Sam has to be eliminated. So if you take 1 million, from this 1 million, if you take 6% interest for how many months? So this is given on 1st October. So October, November, December is the financial year in 3 months. If you calculate for 3 months, that's going to be 15,000. Okay, this 15,000 is exactly considered here, so that has to be removed from the interest income, and 15 has to be removed from the finance cost of SAM. Okay, so let's try to prepare this now. In line by line consolidation, you need to add the revenues 1,500 plus 700, okay, minus this 150,000, because This is included in SAM's revenue, so therefore it has to be removed. Then the total amount will be how much? 2050. This is 2050. Then cost of sales, you need to add again 775 plus 370 plus, sorry, minus minus 150 plus unrealized profit. So unrealized profit is 5000. 5000 has to be added back. Now I explain you this why we need to add back the unrealized profit, because in the previous video also I explained you this particular concept. This unrealized profit will be removed from the inventory. So when you take the inventory cost, inventory is a debit balance. To remove the unrealized profit, you need to credit. So when you credit inventory stocks, your cost of goods sold will increase. Okay, when the inventory balance decreases, your cost of goods sold will increase. So that's why we add this 5000. All these are in thousands, so that's going to be 1000. So when you deduct this 2050 1000, so it's going to be 1050, which is the GP. Then administration expenses, simply there are no adjustment. We can straight away add 317 plus 135. So that will be how much? 452. 452. So we can deduct this amount also. That is the operating profit. So that will be 598. 598. Then interest receivable, as I told you, this 15 cannot be taken as your income. This is intercompany, so 15 has to be removed. So therefore there are no interest income in the consolidated, the group financials. This is the group financials, we don't consider that. Then the finance cost, we need to add 60 plus 20 minus this 15. Okay, so this is, they have taken as income the parent company, because parent company has given a loan worth of 1 million. So this is an income for parent, and this 50 million is a cost recorded in the SAM. So therefore that cost has to be eliminated. So when you eliminate that, that will be how much? 60 plus 80, 65, right? 65. When you eliminate that, your profit before tax will be 533. 533. Then the taxation, you can add both 96 plus 45. There are no adjustments. So that will be 141. So the total will be 392. The group net profit is going to be 392. So now let's move on to these questions and we'll try to answer. Select the correct calculation for cost of sales. All figures are in thousands. Okay. Now what we did, how did we calculate cost of sales? We added 775, 370. Then we deducted the intercompany 150, plus we added the unrealized profit. Okay, fine. So the correct answer will be, as you can see, 775, 370 you need to add, 150 you need to deduct, $5 no, you need to add. This is not the correct answer. 775, 370 you don't add intercompany, you need to remove. So this is not the correct answer. 775 plus 370 minus 150 plus unrealized profit. So this is the correct answer. This is the correct answer for the first question. Second one, select the correct calculation for the finance cost. All figures are in thousands. So finance cost, when you take, we took 60 parent and 20 subsidiary and we deducted 15. How did we calculate this 15? 1000, 6% and 3 months. Okay, so instead of 15 we can take this entire formula. Okay, So now what we have to do is we have to take, let's go through this. 60 minus 20, no, this is not the correct answer. 60 plus 20 minus 6% of 1000, no, so you need to take proportionately 3 months. This is also not the correct answer. The last one, 60 plus 20 minus 1000, 6%, 3 months. So the entire amount is going to be $15,000. Okay, so 60 plus 20, so this is the correct answer. The last one is the correct answer. And finally, select the correct formula to calculate the non-controlling interest share of the consolidated profit of the year. So now here, if you want to identify NCI, so what you should do is to calculate non-controlling interest. So what you should do, so this is the total profit of the subsidiary, 130. From this 130, as I explained you need to eliminate the unrealized profit, because the profit is recognized. Sam sold goods to Park. So therefore the Sam has recorded the profit. So this profit is recognized in the Sam's book. So therefore the unrealized profit of 5 is included in Sam's profit. So therefore that unrealized profit has to be removed. So that will be 125. Of this we need to take 70% and 30% for the non-controlling interest. So this goes to Park, this goes to the non-controlling interest. So when you take 125 times 30, so that will be how much? 37.5. Okay. Now when you take this 392, we can take the breakdown as parent or the Park. This is Park and non-controlling interest. This total should be 392. Okay. Now we have calculated 37.5 as non-controlling interest. This is 37.5. Then the parent or the Park should be 267 plus their portion of post-acquisition profit of the subsidiary. So this one is how much? 125 times 87.5. Okay. So the Park profit will be 267 plus 87.5, which is the, so that will be how much? 354.5. So 354.5. Okay. So when you take this total, that will be 392. So this is how you reconcile the group profit to the non-controlling interest and the parent company profit. Okay. Now for this, what is the correct answer? So what we have to do is we need to take the NCI. Now here it's given the other way around. The NCI percentage 30% of the subsidiary profit after tax. So if you take 130, okay, so 130 you take subsidiary profit before tax into NCI percentage 30%. Then you take this. This is without eliminating the unrealized profit. So 130 times 30 is 39. From this 39, you need to deduct the unrealized profit portion of 30%. So unrealized profit is 5. We calculated here unrealized profit 5. That 5,000 into 30% belongs to the non-controlling interest. So 39 times 5,000 times 30 is how much? 1,500, 1.5. Okay. So 39 minus 1.5 will be 37.5. This way also you can calculate. What you can do is, if you want to identify non-controlling interest, either you take 130 minus 5 unrealized profit, on that you take the percentages, the parent and the NCI. Otherwise you take the net profit as it is 130 take 30% of that. And also this unrealized profit 5,000 also you have to take the 30%. Okay, so which belongs to the NCI. So that has to be removed, then you will get the same answer. So here the correct answer will be NCI percentage times subsidiary profit after tax plus NCI share of unrealized profit. No, we don't add, we have to deduct. Then, and also here it says profit after tax. Okay, and here NCI subsidiary profit after tax, yes. NCI share of unrealized profit on inventory, yes, this is the correct answer. NCI subsidiary profit before tax, no, we don't take before tax, this should be after tax. So therefore the correct answer is the second one. Okay, so this is the answer for this particular question. If you have any questions or any clarification, what you can do is you can comment below. And also if you want to discuss some other questions relating to consolidation, if you have any difficult questions, please feel free to comment below. So thanks for watching. I'll see you soon with another video. Bye for now.